The yield curve is showing the warning signs and has always shown the warning signs of a potential recession. And it's not the yield curve per se, but it's the inversion of the yield curve and then the steepener, the steepening of the yield curve that has predicted basically every single session. Well, in this chart dating back to 1989, but it goes way further back than that. Good morning, good afternoon, good evening, everybody. This is the Macro Ghost, and I need to explain a little bit about what I feel is going on in the economy, both in the short term and the long term. As you guys know, I've been very bullish on commodities as they relate to AI, and I think that bull market does continue for a time period. I think it goes at least into Q2 2026, but after that is anybody's guess. What I'd like to look at today is how we should be able to prepare ourselves for a run-up in stocks, in commodities, get really rich, right? Everybody likes that. And then also get defensive, maybe deep into next year, second half of next year. What I see in unemployment, as I talked about in my last show, which I'll link in the back of this show, or I'll link at the bottom, or I'll link somewhere, is that I fear unemployment is ticking up, and I fear that these jobs are not going to be coming back. They're going to be displaced and replaced by AI. And those are actual real people that need to have real money coming in to satisfy their real existence. And when those jobs go away, they have to find and do something else to pay the bills, to live, to rent, to pay for their expenses. So this is real issue. This is real economics. But first, we're going to just jump right into Bitcoin here. Bitcoin did have that bounce. I said in my previous videos that I do expect the RSI to bounce to 50. I do expect 93 to be hit, and possibly the Gaussian has moved to 106. So I'm upping that target to 106K and say, yeah, we could get a bounce there. I don't know if we will. I'm not God. I can't look into my crystal ball. But if we can get out of this Gaussian channel, I will flip bullish for sure, because I just follow the trend. The trend is my friend till the end of the trend. I do believe that. And so I'm just calling how I see it. Now, back to this crazy shit over here. As I talked about in my last video, from 2025 trailing 11 months, 2024 trailing 11 months, the change in unemployment is 500% for government. That's Doge related. That doesn't count because government is not productive. What does that mean? It means government jobs don't produce anything. They don't do anything. They just sit there and collect a paycheck like Nancy Pelosi, okay? And then she front runs the market with that paycheck, okay? So technology is value accretive. Technology industry does do shit. They create shit. Elon Musk, hardware, Google software, Microsoft software, semiconductors, that's all under technology. Warehouse and logistics, they do create value. Retail, buy and sell goods and services, that's value. So all these are value accretive, maybe not nonprofit, but it's very small. The rest are value accretive. This is value dilutive. Okay, so I don't really look at that change as being troublesome, but I do look at the technology, warehouse, retail, services, financial services, pharmaceuticals, and energy as being troubling signs that unemployment is ticking up. Unlike what the Fed said the labor market is very tight. That's a lie. That's a bald-faced lie. Okay, and manufacturing sector is contracting, which the Fed does admit. They do admit that because, I mean, how can you not? The data says that the ISM is contracting every single month for the last 9 months. And they also say that inflation remains elevated and sticky. Well, yeah, on their CPI lagged shelter crazy shit data. But on the actual rents, no. 40% of the inflation reading is not elevated and sticky. It's at the 2%. And then they say rate cuts are not assured. But I say, well, they're going to be late. They're going to cut in December, and then they're going to have to cut in February, March, April going forward. Okay? I want to get to this and the why. What's going on? What do these squiggly lines mean? Well, the yield curve is measured by, there's many ways to measure the 10-year versus 2. So the 2-year yield should be less than the 10. If it is not, it's inverted. Bad. Okay? That I'm not going to get into why it's just bad. You want the short-term rates to be less than the long-term rates. Otherwise, you have a run away from risk. So people are fleeing risk. And that shows that they don't want to undertake risk. They're going into the 2-year bonds because they're fleeing to safety. They're fleeing away from 10-year or 30-year. I like to look at the 30 and 2, okay? Because that's the yield curve. That's the 2-year. We can even get to the 1 month, but the 2-year versus the 30. Oh, they use a 3-month spread. Great. This is even better. When the 10 versus 3 month inverts, that means people are running from the 10 and going into the 3 because they feel danger. Remember 2022? Danger, right? 2022, not good. 2019, not good. 2007, horrible. 2001, bubble pop. 1989, 1990 was recession to follow that. So it's the yield curve, it's the runaway from risk, and then the steepening of the yield curve that actually predates a recession. So are we seeing a steepening? Yes, we are a little bit. How we can avoid that is if the Fed drops rates, and then the 10-year specifically, the 10-year is very important, and the 30-year, they don't steepen, they don't go up. People don't run away from that risk and run into the 3-month or the 2-year. Okay, you kind of understand what I'm saying here, right? If we see this line, this squiggly line here start to steepen, run away from risk. Sell all your shit, put it into gold. I'm being serious. And so, yeah, Bravos Research, good channel. I follow them. They see a steepening is coming. It's not here yet. This right here, that's the steepening. This right here, steepening. We're kind of there. We're in the middle, but we could avoid that if the Fed cuts the rates. Okay, if the Fed cuts the rates and the 10-year acts normally. What does act normally? Stays at 4%. I don't want the 10-year going to 5, 6%. That's danger. That's a steepener. And that's going to cause a big, big, big recession, probably in the second half of 2026, if I had to guess, which I'm guessing. Okay, so that's the show for today. Thank you for being with me. The show is going to keep getting better and better. I have AI helping me, my little AI bot here editing my show. So I'm not saying and, pausing and blah, blah, blah and doing that. So if you like this, if you stay to the end, congratulations. You win $1 million from me. So just comment at the bottom, $1 million you owe me. And like, subscribe, comment, and stay tuned for the next show because it's going to get better and better. Thank you very much.